So thank you very much, Gideon, for joining us and sharing your research with us. We are very pleased to have you here. Your topic, you're talking about limit order markets under asymmetric information. So just to set the ground rules, we'll give you 5 minutes with no interruptions. And then just like a regular seminar, people can ask questions. And what we'll do to keep it a little easy, participants can ask their questions on chat, meaning raise their hand or indicate they have a question on chat, and I can then announce that you have a question, and then you can ask your question by unmuting yourself. So that will be easier. Because, but every time I say this, no one follows the rules. So anyway, I just mentioned the rule for completeness. Right, so let's begin. Thank you again for coming.
Sure. Thank you so much for inviting me. You know, at Cornell, when we do seminars, people just unmute themselves and barge in. So, you know, I feel pretty much at home. This is joint work with Ayan Bhattacharya. Ayan was a PhD student of ours who's now a faculty at Baruch College and is visiting Chicago this year, next year. And we started working on this several years ago, and it's a difficult problem. And only recently we had a paper that we kind of moderately happy with, so we started distributing it. And we recently, just like a few months ago, got a revise and resubmit from the JF with 2 refer reports, 1 associate editor report and 1 editor report that now we need to satisfy. So at the moment we're scrambling in the revision. So the version that you have is version from, you know, 5 days ago, and 2 weeks from now it will be different. So it's pretty much under revision. So I would appreciate any comments that you may have. Adverse selection in general has transformed market microstructure completely, all of our insights. And most of the insights were gained from the dealer market models of the 80s, right? The Gloston-Milgram is the O'Hara framework that I also call traditional sequential trade models, and Kyle's framework. And those were fantastic frameworks. The only problem is that markets have evolved over the past 2-3 decades, and most exchanges now are not dealer markets, they are limit order markets. So you'd expect the theoretical literature to move with it, and we should start having models of limit order markets under asymmetric information. But that did not happen. And the reason, you know, Christine Paolo and Dwayne Seppi has this survey on limit order markets. Second, my printer is making all kind of noises. I may want to shut it down if I can. They had a survey where they say that limit orders are a relatively simple construct, but limit order markets are complicated beasts because the action space is huge. Everything is huge. And I only know of 3 papers that tried to have a dynamic limit order market under asymmetric information, and all of them eventually resorted to numerical solutions, right? They couldn't solve it analytically. So our goal here was to develop a model of dynamic limit order market under asymmetric information that can be simplified enough to lend itself to a constructive solution. And the way we're going to do it, I'll show you shortly, is basically it's kind of Gloston-Milgram is O'Hara meets Rosu 2009, right? So we take a very familiar information framework from the traditional sequential trade model, and we kind of change it with the limit order markets that we like. And hopefully that gives us new insights, new empirical implications that I will talk about, and we hope also a useful framework that others can use and start extending in many ways. So that's kind of our goal. And when I say that it's kind of Gloston-Milgram is O'Hara meets Rosu, I mean that we are taking the, you know, all the information environment from the Gloston-Milgram is O'Hara framework. So traders, informed and uninformed, arrive under predefined exogenous processes to trade 1 unit asset, 1 at a time. The information environment precludes identification of the informed traders. So uninformed traders need to learn from the order flow, right? And then traders leave the market, you know, after they transact. What we do though, we swap the dealer core of the gloss amalgam-Is-Zihar, right? They have a competitive dealer who sets bid and ask quote and always clears the market, and prices are equal expected value of the asset conditional on the arriving order. We swap that with a fully fledged dynamic limit order market that we took from Yoni Ross's paper. His paper is without asymmetric information. So you've got the limit order market rules drive prices, and you get all the output of limit arrays of limit buy and limit sell orders. Okay, so that's what we're going to do here in this paper. In terms of literature, we started having in the 90s those static limit order models under asymmetric information, right? Larry Glosson is a pioneer here. He was talking about his title was "Is the limit order book inevitable?" Right? And he was of course right. And later on in the 90s, we started to have the dynamic limit order models, but none of them was able to accommodate asymmetric information. Again, I only know of 3 papers, 2 of them relatively recent, that tried to do that. This is a pretty active problem. But they couldn't solve it without numerical solutions. So that's where we kind of enter. So that's the setup. And what I'm going to do, this is a theory kind of presentation. So I'm going to start by setting up a model. I'll talk about all the assumptions we make and why we make them. And then I'm going to go through how we solve it, because part of the contribution in the paper is kind of some contributions of how to solve such models. And then I'll go into some of the insights that we learned. All right, so that's my plan. And again, if you have any questions, you just interrupt me. So let's set up with the model. The model is organized as a continuous time limit order market, right? Traders can submit limit orders that enter the book, or limit orders that or marketable, we call them marketable orders that execute immediately. And that's kind of a basket term for market orders or limit orders that are priced aggressively to yield immediate execution. Any order that executes immediately, we just call them marketable. All orders are 1 unit. By the way, you will see that I put near some assumptions, I put in red GMEO. And those basically the assumptions that we make to replicate the gloss amalgam-Is-Zihar framework, right? So all orders are for 1 unit. Limit order market has the usual price priority, right? The limit sell order at a lower price is executed before limit sell order at a higher price. We've got a continuous price grid, pre and post trade transparency. Orders are anonymous. We've got the familiar Is-Zihar single risky asset that can be either high or low, V plus sigma, V minus sigma.
Gideon, can I ask you a question?
Sure.
Yeah, Gideon, sorry. Just to go back to that context, right? I mean, the introduction of limit order traders in this Boston model. So one of the things with the typical market makers in the past, right, when people were building these models, was this sort of an affirmative obligation, right? So the market maker does stay there and carry some inventory. So when you're thinking about a limit order replacing a market order in terms of getting the dynamics right, are you looking at some of these features also not being present in the current market context, and therefore the assumption that the market orders, sorry, if you replace the dealers with limit orders, you're going to get a completely different sets of results?
Right, because the limit order traders are not staying in the market continuously. They just come and trade and they go, and they don't have any obligations, right? So if you believe that the current market environment, so I'll be kind of careful here. If you believe that the current market environment in many markets don't have those affirmative obligations, people who are always there, and then probably what you will see outside is more similar. And I'll show you the structure in a second of those people who trade and don't have any affirmative obligation. I think that many assets, what we've seen empirically is that some traders endogenously adopt some sort of a market making activity just because it's profitable, not necessarily because they have a market making operations. But they still use limit orders, right? They don't have a order, something like that. So you can think about them, and the only difference then from our perspective will be that they have a continuous presence while ours, come until they and then leave. Okay. Right. I'll show you in a second what we're doing in order to replace kind of the dealer in terms of liquidity provision.
Sure.
So here are their trader arrivals. So we're going to have 5 trader types in the model, all arriving according to independent Poisson processes with constant rate. Again, very similar in spirit to the probabilistic arrival of traders in the Gauss-Milgram-Yohara. We've got impatient uninformed buyers with arrival rate lambda BI, buyer impatient, we're very creative. Impatient uninformed seller, patient uninformed buyers and sellers, and informed traders with arrival rate lambda kappa I. And trader behaves, again, like in the traditional sequential trade model, as if they will arrive in the market only once to trade and then they leave. Now, who are those traders? So we're going to start with the impatient uninformed traders. And they're essentially there to replicate the uninformed traders in the traditional sequential trade model. So they have exogenous trading need to buy or sell for whatever hedging liquidity unmodeled. They use marketable orders. And so the buyers will buy at any price at or below V plus sigma. The sellers are selling at any price at or above V minus sigma. So all trades are going to be between the high and low value, again, like in the traditional Isley-O'Hara type models. So they are kind of the regular noise trades. The patient and informed trader is kind of the answer to Venki's question, right? Instead of a lone dealer that is perpetually present in the market and so on, like in the traditional model, we assume a dynamic flow of liquidity providers that we call patient and informed traders. So they do have a trading need, but being patient means that they're not willing to pay for liquidity, all right? So here, let's say QT is going to be the probability that the value of the asset is high, right? That's the belief of the uninformed traders. So VT is the expected value of the asset from the perspective of the uninformed traders. So here's a typical utility function. This is for the buyers. So we've got the utility is VT, the expected value of the asset, minus the limit order price, right? So this component is the trading profit, minus their expected waiting cost, where cap T tilde is the random time to execution of the limit order. And so they kind of trade off their trading gain against the cost of waiting. And of course, pi, the limit order price is going to be their choice variable. Okay, so they have a non-trivial choice variable here. Now, in the Gauss-Milgram-Yohara, we said that the dealer has to break even on all the trades, right? So to make it equivalent, we assume that the patient traders need to have non-negative expected utility. In that sense, that's really what makes them patient, right? And you can very easily show just by manipulating the utility function that means that they will only choose to use limit orders, right? Not marketable orders, right? They're not willing to pay for liquidity, only supply. And in terms of information, they don't know what the realized value is. They just know the starting probability Q0, and then they will use, like the dealer in the traditional model, the trading environment to learn information. Now, in a limit order market, traders presumably can choose between market and limit orders. And here we kind of assign the uninformed traders market and limit. And the reason we did it is to simplify things a little bit, because we want to focus on the choice of the informed traders between market and limit orders. That's kind of the focus of the model, because we want to know how this choice impacts the way information is incorporated in markets and so on. Okay. So then, who are the informed traders? Informed traders don't have any exogenous need to trade, but they know the realization of the random variable. Again, that's a very traditional sequential trade model. They behave as if they will arrive in the market only once. So exactly like in a Gauss-Milgram-Yohara, they will buy if she, the informed trader, sees a high signal, sell if she sees a low signal. But she still has a non-trivial choice in terms of the type of order she uses. Does she use a marketable order or a limit order? And if a limit order, what price she uses. Now, to simplify the exposition, we assume that the informed traders don't bear waiting cost. That means that kind of their horizon is the same as the random variable, which is similar to the sequential trade models. There's no conceptual difficulty with having them with an arbitrary degree of patience. We actually, right now, the online appendix where we show how to do that. It's just that it doesn't add any insights and just complicates things. So we're not going to do it in the paper itself. which means that if the true value is high, the informed trader's utility is going to be V plus sigma minus the limit order price if she submits a limit order, or V plus sigma minus the ask price if she submits a marketable order and the ask side of the book is not empty, so she can buy. And the fact that she doesn't bear weighting cost means that she has a preference for limit. But I told her she has a non-trivial choice to make. So when would she use a marketable order? You will see that she will submit a marketable order if the limit order would communicate too much information to the market, so it's not worthwhile for her, and then marketable order will be more profitable. Okay, so that's the idea. Now, we really,
Gideon, a quick question, again, naive question, possibly. Again, why do we, I'm familiar more with the Kyle model. Why do we need two types of uninformed traders in this setting? What was the advantage of having the patient and the impatient? And what is that bias?
Okay, so it's actually related to this slide. And so really what we want to do is replicate the information environment of the sequential trade model, which is similar to Kyle. The information environment is that you cannot point to a trader and say, you are an informed trader, right? So the kind of anonymity. And the way they maintain the anonymity is they hide behind the trades of the uninformed traders. So in Kyle, they submitted the same rate. In Gauss-Milgram, they basically use only marketable order. They will need to hide behind the uninformed traders as well here. But because in the limit order market, you have both marketable orders that arrive and limit orders that arrive, you need to have uninformed traders submit both marketable limits and marketable orders and limit orders. Otherwise, the informed traders wouldn't want to hide using one of them. So to have a non-trivial choice of the informed trader, you need to have uninformed traders trade both.
Okay.
And you can give them choices, but here we decided not to give the uninformed trader choice, but rather give the informed trader the choice. So that's the reason.
Okay. Ravi has a question. Yeah.
Yes, Ravi.
Yeah, hi, Gideon. Just a simple question. You were mentioning that, the informed trader won't want to reveal his information. So that looks reasonable. You don't want to reveal too much information. But what I'm asking is, what is the intuition for how exactly is information revealed? Through the trade order size, or like how would other people infer that this guy's an informed trader and not a uninformed patient or an uninformed impatient trader? Like,
so this is a fantastic question. The size is going to be always a unit order, so it's not going to be the size. Traders are going to, the uninformed traders are going to learn from the direction of order, perhaps from the frequency of order, even from time without orders. So I will show you later. I'll talk later on about the learning.
Okay, so it's quite complex. It's not. There's no simple intuition for this.
It's not that complex. In some sense, it's just that because it's a Poisson arrival, then will. And in fact, it only arrives at the end, at the completion of the equilibrium. But what you're actually asking is related to this slide. Why? Because in a particular, in a Gauss-Milgram Yohara, the informed has a trivial choice: buy or sell, high or low. Here, since they have a non-trivial choice between order types, we need to specify their off-equilibrium beliefs. So we will need to say that revealing oneself as an informed trader entails a cost that is at least as much as the expected utility that she can make by revealing her information and supplying liquidity in a market where everybody knows her information. And that will be why she doesn't reveal herself. And I'll try to explain to you why we actually, first of all, this is a very realistic assumption. I can tell you that I'm a member of the Economic Advisory Committee of FINRA, the Financial Industry Regulatory Authority. And traders don't want to reveal that they are informed traders in any way, because then FINRA hunts them down. And even if their information is legal, just to defend yourself from the regulator is very costly. So in what way, so how does FINRA, by the way,
Okay, sorry to interrupt you. So it's not like in Kyle, like in the Kyle model, for instance, you don't want to reveal too much information because you want to maximize your profits, and so there's an equilibrium amount of information you want to reveal each period.
Right.
Like
in some sense, it will be like that. Here, they're going to decide. if they're going to hide behind the limit orders or the market orders. And you ask what is it that will cause everybody to find out that you are informed? And the answer is, if they submit a limit order at a price that an uninformed trader, remember, there's a non-trivial choice of price for a limit order. If they submit it at a price that an uninformed trader would never choose, then immediately will see, oh, you're an informed trader, and beliefs will adjust. That's exactly how FINRA actually works.
So the price would be the price point entered in the limit order reveals whether this guy is an informed trader or not.
And they will not do that, right? They will choose equilibrium to mimic the uninformed.
Except here, they don't want to reveal because of legal problem. I mean, running into problems about informed trading. And whereas in the Kyle model, it's just optimal not to reveal too much information and reveal it in a progressive way.
In some sense, you can say it in Kyle model it's also assumed, right? Because you basically assume that you got to read. In the Kyle model, in some sense, you assume that if you revealed all your information, prices adjust immediately, right? Prices are expected. So it's a trivial assumption. Here it's not trivial, but all of those models need to assume it. They just never specify it because it's so trivial, right? Because the price is not created in the market. The price is assumed to be the expected value of the asset conditional on order flow, which is a pricing equation. It's never a process.
It's an assumption. Okay. Yeah. Okay.
All right. So
thanks.
So now you know what the traders are. Let me discuss the equilibrium concept in this model. So there are basically two games that are nested in the model. We've got the instantaneous game at time t, which we call GT, which is basically the game at each node of play when the players update information. And because it's continuous time, they can update information at every instant. And then we've got the long horizon game G, that it's the collection of all those, instantaneous games. And you may think that, wow, that's a typical structure of a perfect Bayesian equilibrium, so that will be easy. But remember, we're using a specific limit order market that was, created by Yoni Brosu in his 2009 RFS paper without information. And he doesn't use Bayesian Nash for the GT. He uses essentially an equilibrium concept that reduces to rationalizability. And he actually has a very nice discussion of that in his paper. The idea is that, if you're in this instantaneous limit order game between limit order traders, if a trader were to choose a limit order price that is not an equilibrium price, that will trigger a repricing response from another trader, that will in turn trigger a repricing response from another trader, and so on and so forth. And so you will never get an equilibrium. But so given common knowledge of rationalities, traders should be able to reason through this chain, and they will submit the orders only in the distances that correspond to equilibrium. Now, Russell actually doesn't show you what the distances are. One of the contributions, and I'll show you that very shortly, is we can actually tell you what are the price differences. We can find the prices explicitly in a model. He does implicit things through the utility function. We can actually show you what the price is. So Russell's solution is some sort of a dynamic version of rationalizability, but he doesn't have information. So we take his equilibrium and we extend it. We kind of borrow two things from perfect Bayesian to create a solution concept that is tailored at limit order markets under asymmetric information. So the first thing that we borrow is, of course, at every node of play, at every instantaneous game, traders choose their action based on their beliefs at that time, QT. Okay, and the other thing is that beliefs evolve, are updated according to Bayes' rule as you move from one instantaneous game to the other. And that's kind of also the same in traditional sequential trade models. So in some sense, we create the perfect Bayesian extension to his equilibrium. So here's the official statement, the formal statement of the equilibrium. An equilibrium in the instantaneous game GT is a set of limit order prices. We call the limit sell orders XT and the limit buy orders YT. So we've got their prices. And you've got the choice of the patient uninformed traders conditional on their beliefs QT between submitting limit orders and leaving the market without trading, and the choices of informed trading between submitting limit orders, submitting marketable orders, or leaving the market without trading, such that given common notion of common knowledge, of rationality among the players, they have no incentives to reprice their limit orders or change their choices. And then an equilibrium in the long horizon game is simply the sequence of those instantaneous games such that all beliefs are updated according to base rule and traded after their choices, right? Canceling and submitting and resubmitting limit orders, leaving the market, whatever, in accordance with the way their beliefs change. Okay, so that's basically it's going to be our equilibrium. So this is the setup of a model. This is a model. Before I'm going to show you what we do, just to kind of point to where's the novelty. First of all, I'm going to show you how we can obtain the equilibrium prices of limit orders in the market by using the concept of wait time to execution of these orders. So that's going to be one contribution. And then recognizing the inherent recursive structure in a wait time, I'm going to show you how we can always compute the wait times, and because prices are essentially wait times, we can compute all the prices. And this is how we're going to construct the equilibrium in the instantaneous game. And then, of course, we will deal with the update of information, and it allows us to solve the model and provide new empirical implications and so on. All right, and it's an interesting new modeling framework that I hope other people can use. Okay, so this is what we're going to do. And I'm going to start with the wait time. The wait time is so essential to this model. So first of all, I'll define the notation. Right, this is a theory paper. You'll have notation here. So let's say that we have this structure. We've got a limit order book with 4 limit sell orders. X1 is the top one. X4 is the ask price in the market. 2 limit buy orders, Y1, Y2. And so we kind of always denote a particular configuration of the book by superscript. X4, Y2 is 4 limit orders on sell side.
Gideon, Ravi has a question. Let's jump in whenever you want.
Gideon, sorry to interrupt you once more. So let me ask the question slightly differently. If we observe that there are too many marketable orders being entered, what could you infer? I mean, intuitively, or in the other extreme, if too many limit orders are being submitted, then what would the market infer? I mean, something about the frequency of limit orders or frequency of market orders is going to reveal information, right? In
right. They're going to learn, as you will see shortly, the strategy of the traders is going to translate to a different arrival rate. The intensity of order arrival will be time dependent and beliefs dependent. And that's how they're going to learn information.
So my question is, if they see too many marketable orders, what would they infer? That there's good information, or maybe I'm asking a wrong question. I mean, what is the kind of information which would be revealed?
I'll show you shortly, but remember, this is a limit for the market. There's no divine creature that is standing there and just executing all the marketable orders. If the marketable orders exhausted the limit orders in the book, there are no executions, right? The trader will have to leave the market without trading, right? So this is actually a much more realistic kind of market structure.
Okay. So please go.
Okay. All right. And in some sense, it's interesting. Your questions are all about the information, and the information is at the end of the model, because in a limit order market, there's a lot of things you need to do before you even get to information in order to think about prices, because there is no price setting rule, right? The price is created by the strategies of all the traders and the way they arrive in the market. So,
Gideon, can I ask you a question too? This is Venki. Sorry to interject here. Your model, very similar to the other limit order papers, is assuming full transparency of the book, right? So in the sense, if you do have iceberg orders, or if you have the system where people may not be able to see unless they kind of link the order book with the trades that are happening, it will be very difficult for them to see who has actually traded. Is that a fair thing? You're assuming full transparency of the book?
So actually, Anne and I talked about it. I think that will be a pretty nice extension of this paper. I think this model can accommodate things like that, right? Because then you can learn, when we'll talk about learning information, you would be able to learn from arrival of marketable execute order that execute, but arrival of limit order will now only going to be partially informative, right? Because some of them you assume that cannot be,
Right.
cannot be observed and so on. So you can actually play with it. It's not going to be in this model that I'm going to, present to you today, but I think there are ways to incorporate things like that in the model.
All right. Thank you.
All right. So the way I'm going to at least notationally define. So when I say wait time for execution of limit orders, I actually mean that it has a definition, the expected value of the random time, whatever. It's simply how long you need to wait, how long uninformed traders expect to wait for a limit order, specific limit order. Let's say X4 can be anyone. Let's say it's the ask price, given a particular configuration of the book. So this is the notation WT. You will see that it will be time changing, so it has to be indexed by T of a particular order X4 given this configuration of the book with 4 limit sell orders and 2 limit buy orders. And in order to make headway in thinking about prices, and we need to talk about strategies of the uninformed traders first. So the impatient ones are easy, right? It's like the noise traders. Submit marketable orders as long as the bid is greater than the minus sigma or marketable buy orders if it's less than B plus sigma. The expected utility of the function of the patient and informed traders, remember, consists of 2 components, right? This is just, for an example, the bias. We've got a trading profit component and the cost of weight component. And the priority rule of limit order market is that the wait time of a limit sell order at a lower execution priority, let's say a higher sell price, is going to always be at least as high as the one of the order below it, because the order below it needs to execute before. And so that trade-off between price concessions and wait time is what allows us to pin down the equilibrium prices in the limit order. So let me show you how. More notation. This is just actually a pretty ugly notation, for a very simple concept. We call it price gap. Price gap is simply the distance between 2 consecutive limit order prices. So this is the price gap between, let's say this is the top order in the sell side and the second one, the one just under it. So 2 consecutive orders, given that in the book there are 2 limit orders on the sell side and 3 on the buy side. Okay. So let's do a thought experiment. Let's say I'm arriving, I'm a limit order, patient limit order uninformed seller. I'm putting my limit order in the book at a certain price, and then Venki comes. And Venki is another patient limit order seller. And he undercuts me, right? Puts it at a price under me because, that will give him priority. Now, the instant he's doing that, my expected utility just went down, right? Because now I will have to wait for his order to execute before mine can. And because time is, is costly, then my expected utility went down. Now, I can respond, right? I can then cancel my order and resubmit it at a lower price, undercutting Venki, and then I'll be again priority. But Venki knows that. He's very smart. So when he comes into the market, he will submit his limit order at a distance that is just enough so that if I submit it at a lower price, the loss in utility from a lower price will be exactly equal to the gain in utility that I will get from gaining back the priority in execution. So in terms of notation, so I was, when I came, if Venki undercut me, so now I'm the higher sell orders in a book that has 2 sell orders, right? If I reprice my order down, so now I'm going to be the ask price, given that there are 2 orders, that difference in wait times that is going to be exactly equal in equilibrium, how much you need to give up in price between the 2 orders, right? And so that's kind of the rationalizability argument in Yoni Druso. He describes it and he does stuff in terms of expected utility, and we actually do it, and that allows us to pin down exactly the prices. At least at the moment, it's in terms of notation. You will see that we'll be able to compute them. Now, at the moment, we still have just the price gaps. In order to get all prices, we need basically at least one anchor and tell us where the gaps stop. So we need the price boundaries. So we have a proof in the paper that the first, and I'm going to always talk about sell orders. The buy orders are basically symmetric. The first limit sell orders in an empty book will always choose the top possible price, V plus sigma. The idea is like a monopolist, right? There's only a probabilistic chance that somebody would undercut and so on. But then, so I'm putting it at V plus sigma. Venki comes, he's going to put it V plus sigma minus the G gap and so on. And Ravi comes, and none of us were executed, putting at V plus sigma minus G1, 2, minus V2, G2, 3, and so on and so forth. When would patient uninformed sellers stop submitting limit orders? Remember, we said that they're going to need to have non-negative expected utility. I just rewrote their expected utilities, moved the price to the other side. In some sense, that means that the price has to be at least the expected value of the asset plus the expected cost of waiting for execution, right? Otherwise, they're not interested. And that's really going to give us the lower boundary, right? So we define something called a full book. And so the sell side of the book is full if the next patient uninformed traders who arrives in the market would choose to leave without submitting a limit order, because submitting it at an equilibrium price that satisfies the gap equation would result in violating this break-even condition, and so it's not worthwhile for him, so he's leaving. And so that basically, the notation, the number of limit sell orders in a full book is FS. So price of X FS, given that the book is full on the sell side, is going to be VT plus the weight of that FS. Okay, so with this, from the strategies of the uninformed trader, we can basically pinpoint all the prices if we just knew how to compute the wait times. So now I'll tell you how we compute the wait times. And to do that, we need to think about the informed trader strategies, right? So remember, the goal was to replicate the information environment of the Gossamer O'Hara framework. So informed traders don't want to reveal themselves, so they need to hide somehow. And so we made three assumptions, right? They arrive to the market only once to trade a unit order. They don't want to reveal themselves, so they will have to hide either behind limit or market orders, and they don't bear waiting orders. So let's think about it. Let's say an informed trader arrives in the market and she saws a low price, a low value, V minus sigma. If the sell side of the book is not full, what do you mean? If an uninformed trader who would arrive in the market would still have a gap for him to submit a limit sell order, because the informed trader doesn't bear waiting cost, limit orders will always be more profitable for her than marketable orders, then she would choose to submit a limit sell order, and she would use exactly the same gap as the patient uninformed trader, because any other price will reveal her immediately. So she will choose exactly the same price. And knowing that that's the strategy of the informed trader, the uninformed traders, if they see that the sell side of the book is not full, they now expect the arrival rate of limit sell orders to be lambda SB, right? The arrival rate of the patient uninformed, plus 1 minus QT lambda I. So they expect the informed traders to arrive, but only if they saw a low signal, which is 1 minus QT. And of course, they know the informed trader in that case would not use marketable orders, so they expect the arrival rate of marketable sell order to be lambda SI, just coming from the impatient uninformed trader. Now, let's say the same informed trader who saw a low signal arrives in the market and the sell side of the book is full, right? So we know that the next patient uninformed trader would simply choose to leave the market, because otherwise that would violate her break-even rule. Then that informed trader knows she cannot submit a limit order. Any limit order price she will choose will reveal herself. So if the other side of the book is not empty, she will simply take a marketable order and immediately transact, right? Because she would still make money from her information this way. And so uninformed traders can reason through that strategy of the informed traders. So if the sell side of the book is full, they expect the arrival rate of marketable sell orders to be coming from the impatient uninformed traders, plus informed traders if they see a low signal, 1 minus Q. And at that point, they know that the limit sell orders only arrive from uninformed, so their arrival rate will be lambda SP. So they can basically reason through the strategy of the informed traders in equilibrium and know what should be the arrival rate given state of the book. And as Ravi said, that depends, of course, the arrival rate will be dependent on the strategy of the informed trader and will be dependent on their beliefs, right, about the asset value. So now, when the uninformed traders have figured the arrival rate, we can use those primitives of the economy, right, the arrival rate and the beliefs, to figure out what's going to be the wait times. And to do that, you'll see some kind of long equations, but I'll go over one term at a time because the recursive logic is actually easy to understand. So I'm calling summation lambda simply the sum of all arrival rates. So 1 over summation lambda is the expected wait time for the next arrival. And with Poisson, the probability that that arrival will be, say, a marketable buy order if the buy side of the book is not full is lambda bi over summation lambda. All right, always the arrival of that particular divided by the total arrival. All right.
Gideon, can I ask a question? Just going back to what you said earlier, right? So if the sell side is full, and if there's an informed trader coming in, he's likely to put in a marketable limit, marketable order, right? So that's how he would want to he or she would take advantage of the information. But given that still, there is a possibility that they may still have need to come back again with another marketable order, right? So there would be a series of marketable orders to take full advantage of the information. So would that reveal the information rather than, is that possible that they would reveal information by sending a series of marketable limits given that the book is full on the limit side? So
not in a Glosser-Milgram model, right? The Glosser-Milgram is the O'Hara model says that the arrival of trader is probabilistic, right? They assume that each one of them is a different trader that arrived independently to the market, saw the signal and can only trade one order. And we are basically taking exactly their assumption. So it's not the Kyle's single informed trader strategic that need to pace him or herself. It's each time it's a new informed trader.
Got it.
So what will happen, it's not the same informed trader will come back. But as long as so let's say I'm an informed trader and the sell side of the book is full, I'm going to submit a marketable order. Everybody expects informed traders, if they arrive, to submit a marketable sell order. As long as the sell side of the book continues to be full, because all I'm going to do with my marketable order is eat on the buy side, then people would expect marketable
there would be an
orders,
update.
right? Only if suddenly a marketable buy order arrives and the sell side of the book is no longer full, now they would expect limit sell orders to carry information. Right?
Got it.
All right. All right. So now, let's say I wanted to calculate a certain wait time in the book. So let's say I'm going to calculate the wait time of a limit sell order, the ask price, that when the sell side of the book is full. Let me start with the buy side of the book is full as well. What can happen, right? I'm going to wait for the next arrival. Depending on which order arrives, either I get immediately executed or I'll need to continue to wait. So we're going to think one step at a time. So what is the wait time for the ask price in the market when the sell side is full and we're starting with the buy side is full? And by the way, it really matters for us what's happening on the buy side, because whether that's full or not will depend on whether the marketable orders that come and can execute me can come from informed or uninformed. So I need to think about every possible configuration of the other side of the book. This is what makes adverse selection complicated, because without adverse selection, two sides are independent. It's very easy to solve. Our model becomes the one recursive equation. Very nice. But so here it is. Let's say we're waiting for the next trader that arrives after 1 over summation lambda. If that trader is a marketable buy order, how do we know that? That will be with probability lambda bi, right? The impatient buyer plus qt lambda I, because the buy side of the book is full. Then my order executes and I'm good. But if 1 over summation lambda pass, and instead of a marketable by order, a marketable cell order, and that can come because the cell side of the book is full from the impatient uninformed plus the informed, then the bit side of the market has one order executed. I still need to wait. How much? WT XF, right? I'm still the ask. Nothing happens on the sell side, but now the buy side is no longer full. It has FB minus 1. Okay, and if a limit buy orders arrive, we know that both sides of the book is full. She will simply leave, and I'll have to wait exactly the same time. The same thing with the sell. So I enumerated those 4 possibilities. I can rearrange. This is simply a linear equation that gives me my wait time for execution in terms of the wait time for execution of my order if the book is no longer full but has a minus 1. All right, so let me try to find this one, the one with a minus 1. I can write, this is another equation where I try to find the one with a by minus 1. And now, if a marketable buy order arrives, and now notice that you can only arrive from an impatient buyer because the book on the buy side is no longer full. So the informed traders, if they see a high order, will use the limit order. I'm going to be executing. If I waited and a sell limit order arrive a marketable, it can still come from impatient or informed and so on. And in that case, another buy order will execute. So I'll have to wait. My side hasn't changed, but now the other side has a minus 2, and so on and so forth. And if a limit buy order arrives, it will bring back the buy side to be a fully book and so on. And that's, so this one I know from the previous equation. So I'm basically getting the FB minus 1 equation in terms of FB minus 2. And I can go like that recursively for the limit orders, possible limit orders on the other side of the book. When I get to 0, nothing can change further. So I can solve the entire system. It's a system of F plus 1 linear equations in F plus 1 unknown, always can be solved to give me the expected waiting time, given any possible configuration of the other side of the book, right? And because we know that prices in the book are just those differences in wait times, then I've basically solved for all the prices in the book. And we know that those are optimal for the strategies of the traders. So I fulfilled all the requirements of the instantaneous equilibrium at GT. What I still need to do is go back to Ravi's question about update of information, right? Because I need to think about the long horizon game, how traders update their QT, their beliefs, as they see things arriving. And here we simply use Bayesian updating. So they uninformed traders know if informed traders use limit or marketable orders, but they don't know if whether they buy or sell. And so it's just set up, I put here the Bayes rule, but it's not done. So if you see a marketable buy and the buy side of the book is full, you know it's carrying information, you will recalculate your beliefs. And in this case, your beliefs are going to go up. And the actual proof here, Bayes rule is not a proof, is we are actually showing that if you update so that the beliefs are higher, then what's happening is that the gaps on the sell side are going to narrow, the gaps on the buy side are going to be widening. So all limit orders are basically canceling and repositioning themselves at different prices that reflect now their updated beliefs. And of course, if the buy side of the book is not full, the arrival of a marketable orders will not cause any cancellation and resubmission because we know it doesn't contain information. But an arrival of a limit order will cause the same thing, the beliefs to be updated upward and all the traders to want to cancel and resubmit. So in some sense, the arrival rates are dependent on the state of the book, but the state of the book would change as orders arrive. It's in continuous time, but it's useful to think about them in like steps. So first step, when an order arrives, everybody's recomputing their beliefs based on the orders. They're repositioning the orders, canceling and resubmitting. And then, the arriving orders can actually position itself if it's a limit order in the right place in the book or execute the limit order in a price that reflects already its information content, very much like in the same spirit as the Gloucester Milgram is the O'Hara regret-free prices. So this is essentially the solution for the equilibrium. We solved the instantaneous one, we updated with with Bayes' rule, we have the equilibrium. So what I want to do now is just talk about a few of the insights that come out of it. Now that we have the equilibrium, let's think about what it gives us in terms of empirical implications and things like that. And the first thing is that the informativeness of arriving marketable and limit order depends on whether the book is full or not full. And you can think empirically about several different ways to operationalize that concept. So when the book is full on both sides, the spread is going to be narrow. When the book is not full on both sides, the spread are going to be wide. So when the spread is narrow, informed traders demand liquidity by submitting marketable orders. When the spread is wide, they supply liquidity using limit orders. So that's going to be one empirical implication, that marketable orders will have a larger permanent price impact when the spread is narrow, and limit orders will have a larger permanent price impact when the spread is wide. And this is interesting because this is one implication that doesn't exist yet in that literature, limit order markets, despite the fact that it sounds very intuitive. Now, if you want to estimate it, of course, remember when I said wide and narrow, it's kind of time series perspective, right? Wider than the stock has usually, or narrower than the stock has usually, and so on. And another thing if you want to test that empirically is, of course, we have continuous price grid. And some markets, many markets have tick size. So you need to take into account that that will introduce some patterns, right? So if the stock is traded at a spread of 1 tick, nobody can undercut, right? So that's going to be by definition a full book. But there's still, if you're using a spread side, there's still going to be misclassifications. And the reason is that we've got 4 states, right? Full on both sides, not full on both sides, full on one, and not full on the other, and so on. And the spread has only 2 states, narrow and wide. So if you want to reduce misclassification, you could use not just the size of the spread, but also the frequency of an order arrival in a given interval, right? Because we know that if informed traders also use marketable order, then the arrival frequency will be higher. So when the spread is narrow, a higher frequency of marketable orders should result in a larger permanent price impact than a lower frequency of marketable order that may indicate that the book is actually not full. And similarly, when the spread is wide, a higher frequency of limit orders would result in a larger permanent price impact. And you can even think about using depth in the book as a way to operationalize a full book. So a marketable order will result, right? Of course, a full book will have more depth than a not full. So a marketable order will result in a larger permanent price impact when there's more depth than usual on the same side of the book, right? Then less depth than, let's say, than the book. A limit order, exactly the other way around. So there's really a way to look at the state of the book and frequency of arrival and map that into what should be the information arrival, the permanent price impact of orders. And by the way,
there's a question from Nishi Malhotra. Nishi, please go ahead, ask your question. Yeah.
So my question was that are we taking into account the modification of orders? Let's say if one trader, he has submitted an order and it was a limit order, now he modifies the same order. So will that be taken care of in the model?
Yeah, so in some sense, that's really what happens every time beliefs are changed. Remember, one of the conditions of the equilibrium was as beliefs change, traders cancel and resubmit their orders in accordance with the new beliefs. And in fact, that's kind of my slide before last, because you will see a very active limit order book, right? Because as traders' beliefs change, all the limit orders will be canceled, resubmitted in other prices, and so on and so forth. So that's definitely part of what you would see if you would observe this model.
Okay.
Even the passage of time itself without order can be informative. So, you know, we actually assumed in the main exposition that informed traders buy and sell in the same intensity, but that's kind of a special case. But, you know, it could be that the buying intensity of informed traders, if they buy, is different than the selling intensity, right? Maybe because of short set constraint. Maybe now after GameStop, all those hedge funds are really afraid of being short squeezed, so they don't want to sell as much as they want to buy. And in fact, the model has implication So let's say the intensity of buying by informed, given that they see a high signal, is higher than the intensity of the selling, given that they see a low signal. So the passage of time without an arrival of an order would imply that Q would be updated downward, which leads to repricing in the book, so that everything moves down. And the reason is that if buys would be more frequently seen when there's good news than sell when there's bad news, then not seeing any buys or sell would mean that it's more likely that it's bad news. And of course, if it's the same, then the passage of time would not change beliefs. So you can use actually the repricing of limit orders in the book to test hypotheses about the intensity of informed traders' arrival, which is really nice. Now, going back to Nishi's question. In a limit order market without asymmetric information, really all our models say, well, limit order is there and it's waiting for execution. When it's executed, it's not it's waiting. In a Glass and Milgram, it's the O'Hara, there are changes with order flow, but only the best bid and ask prices. Here in the model, every time there's an update, limit orders get canceled and repriced. And so one insight is that information asymmetry in a limit order market drives frequent cancellation and resubmission throughout the book in response to the information conveyed in the order flow. Now, you might think that this is a trivial insight. It's a trivial because it's part of the construction of the equilibrium. So, but there is a reason I'm mentioning it separately, because I've been working for the past more than a decade on high frequency trading with Joel Hasbro and with Eckhard Boehmer and Dan Lee. And, we've seen tremendous increase. Joel and I wrote 2 papers about that in the numbers of cancellations and resubmissions over the past couple of decades. And so you've got those sequences, we call them strategic runs of limit orders get canceled, repriced, canceled, repriced. And you've got plenty of people that say, oh, that's because of some nefarious trading by high frequency traders that take advantage of the market and so on and so forth. And that's because we've no model that says, well, that's what you should see all the time. Well, but one model perhaps that didn't get much traction. But it's important to understand that when you've got a limit order market structure under asymmetric information, this should be the state of affairs. Right, so this provides this rationale for these constant revisions in limit order. That before that we probably haven't seen it just because there were too many frictions, very large tick size, very costly. Technology brought down the cost of revisions dramatically. And so one of my takeaway from this is that all those policy implications that people want to do, oh, we need to somehow restrict the number of limit order cancellations and revision of stuff by traders, it's not going to be optimal if basically the frequent cancellation and resubmission that you're seeing is driven by uninformed, basically changing their belief, protecting themselves, if you may, from the informed.
Gideon, there's one more question, sorry to interrupt, from Samarpan. Go ahead, Samarpan.
Yeah, hi, Gideon. So, your model do not have differential speeds, right? The speed differential is not there, which is there in Hoffman. The traders with different speed. Now, if that is not there, then how come your model's implication is this frequent resubmission and cancellation by, how does that justify this?
Okay, so it does have different speeds just because each trader type arrives at a different speed. What we don't have here is the same trader type has multiple speeds. Although, again, this is something that one can build into. The reason there are frequent cancellations and resubmission is that there are information asymmetry. There is no information asymmetry in Hoffman's paper, right? Hoffman's paper, everything is public information. The only issue is the peak of risk because of stale orders. You're not fast enough. Here, it's the asymmetric information that drive the change in beliefs, and prices are dependent on beliefs, okay? They're not dependent through the very simple expected value of the asset given all available information like in a traditional sequential trade model. It's much more complex because here prices are created by the strategy of the traders, but the strategy of the traders made them belief dependent, and that's how they change. And that's really what makes it different, because that's kind of my conclusion. You get the same things like in sequential trade models, that order flow brings information to the market. Impatient and informed traders always lose. But you've got lots of other things, right? You've got the transaction prices that reflect both expectation on the true value and the compensation for liquidity provisions, right? It's not the conditional expected value given whatever. Informed traders use both marketable and limit orders depending on the state of the book. We've got new empirical implication on the permanent price impact, how it's related to the state of the book, order flow, time, and we've got lots of cancellation resubmissions throughout the book. And so I'm kind of happy. I think that those empirical implications can be tested, and that kind of will be the test of kind of the economic rationale behind the model. But I hope that beyond the empirical implications, people will be able to use it, because some of the comments and the questions that you had, how about we have, iceberg orders? How about we have multiple speeds of the same trader type? I think a lot of them can be accommodated because they come down to differences in arrival rates and stuff like that, and that should be done pretty easily in the model. So I hope other people will use it as well.
Avi has a question, yeah.
Yeah, Gideon, so does your model have any cross-sectional implications? For instance, different stocks might have different sigma, right? So the repricing would depend on sigma, presumably. So is there any interesting?
Yeah, and so for example, in the first version of the model, we had a proposition on what's happening when sigma changes. And actually it was monotone in price impact. Price impact increased in the volatility, and it's kind of intuitive. We actually took it out just because the paper was kind of getting long, and the editor was saying it has to be much shorter, just a little bit shorter. But yes, you can derive cross-sectional implication based on sigma. You can think about cross-sectional implication based on frictions. You can think about cross-sectional implication based on relative arrival rates, say of patient versus inpatient. It's not construct. And the only thing that you're right, the reason we didn't do V high is 1 and low is 0, we actually had the sigma because we wanted to get some sort of cross-sectional implication. At the end of the day, that's not probably going to be our focus in this paper, but I think you can generate a whole bunch of them.
And just to continue on that point, if there are two markets, or like if the tick size is different, so as the tick size increases, would that presumably that would make the order book more thinner, or like, maybe there are some implications I have to think through.
So what it will do a couple of things, and you will have to correct for that in the empirical analysis. It will make the state of a full limit order book more likely, right? So there will be because if you kind of fit a continuous price into a grid that becomes more coarse, then there's going to be a larger area where it's going to be a full book. So in that area, we'll expect that marketable orders will carry information as opposed to limit orders. Another thing, so that's one thing.
So in markets where like the tick size is based on some price level or something, like in Japan, you could find different implications. Yeah.
Yeah, you can actually test it. People have tested all kinds of things. I even have a paper on tick size, but you can use a structure like that to use the breaks between the price level to test interesting things. Yeah, it's a nice idea.
Hey, Gideon, I have a question. I mean, long time back when I was working for Goldman, we used to look at the asymmetry in the book as a sort of a signal for short-term price movements. So from whatever you are saying, it's really the asymmetry. I mean, basically, if the book is not full, it's full only on one side or something like that. It's really, that's not the information, but it's the information of how fast it is getting full, right? I mean, basically, if you're expecting the order book is not full, that's where the informed traders would start putting orders in, right? So to fill it up, because otherwise,
so you can think about
they would be posting marketable orders.
Right. So you can think about several things. First of all, a thinner book will include more information than a thicker book, right? Because a thinner book, would mean that the limit orders can be informed. that arriving limit orders will be informed, and so on and so forth. And you could use the difference in depth. Difference in depth will tell you in our model what kind of orders will bring information, right? Incoming information. And that will give you a sense of perhaps where prices would go, because the permanent price impact then of a marketable order on the side that is fuller will be higher, right? And stuff like that. So yeah, it does create, you can play all kind of implications in the asymmetry of depth to get differential information content going up or down and so on.
Ravi,
Yeah, just a comment. I don't know if that would be very helpful, but since you mentioned that sigma is not really important because it's generalizing the model, you could use sigma equal to plus minus 1 and set up a simple numerical example where you kind of compute the prices. Maybe that would help the reader understand. It's just a suggestion, or maybe it's...
I completely agree with you. And between Friday afternoon and Sunday morning, I cut it from the paper. It was there. I'll put it back. It was there because we felt like you, but between Friday and Sunday, I changed completely section 5. So the learning, the numerical example was there exactly to show the update, how, here's an arrival of an order, what happens to prices. And I changed the way the stuff, and I didn't have time to change the numerical example. So we will put it back. I completely agree with you. I think it's really nice to simply put, because we can compute everything in closed form, we can simply say, this is the arrival rate and this is fact, and the stock price, it can be 34 or 26 with equal probability or whatever. And here, let me show you what's happening when things occur. We'll do that. Thank you. Yeah. I think you're right. It's missing. It's very nice to see that visual.
Yeah, thanks.
Well, thank you so much. I really appreciate the comments. I appreciate the questions. It kind of sharpened my thinking about how to rewrite. As you saw, we're rewriting it constantly. Hopefully, over the next couple of months.
Thanks a lot. Thanks a lot, Gideon.
Thank you.
Thanks to everyone for attending and sharing your thoughts.
Yeah, thank you. Good day.